Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hey everybody, welcome to the podcast today. I am very excited to have my good friend and colleague, Austin. I think we've known each other for probably about a decade now. We've been doing this stuff together. Austin has joined me for some international travel on some occasions. We've done a lot of work together. So I'm super excited to kind of introduce everyone to him, get his background going, and talk about a very significant case, which is the Moore case. It's a Supreme Court case. But before we get into that, let me just give everyone a little bit of background from my perspective, and then I'd love to get Austin to give me a little bit of his background. But Austin and I kind of intersect at a very unique segment of tax, which relates to what we call the big picture item is what's called the F-bar. And for people in the audience that don't know what that is, it's a weird acronym because it stands for the Report of Foreign Bank Accounts, which comes into play back in, and we'll talk about the history of some of these things, but it comes into play back in 1970, believe it or not. That's Richard Nixon signed the Bank Secrecy Act. What was happening during that time period is a lot of very wealthy Americans, actors, sports athletes, were stashing money in foreign jurisdictions, particularly the Caribbean. And the government got wind of this and wanted to make sure that there was reporting on it so that they could catch tax evaders. And if you read kind of the articles that occurred after the F-bar came into being, the IRS got their hand slapped because they were very aggressive in their pursuit in the 80s. And so the F-bar in the 90s basically was kind of unused. No one really filed it. It kind of went to the wayside. It was just something that was there, but not really enforced. Then we get to 9/11 and the events that happened there and the Patriot Act, and the F-bar got, new life. It got reinvigorated, but wasn't really used a lot until our good friend Bradley Birkenfeld, hopefully I pronounced that right. He is a private American banker that got to see the interlinings of UBS and the Swiss banking system. There was a law passed, I think it was in 2007, where it's a whistleblower law, where if you were to disclose illegal activities related to tax, you would be able to get 30% award of any tax that's collected. And Bradley, he knew that there was a lot of unreported income, a lot of stashed foreign financial assets in Switzerland. That's commonly where people were doing it at. The Swiss were, sending what we call promoters into the U.S. to promote, hey, come put your money into our bank. Come invest in these products. There'll be, there's Swiss banking laws, secrecy laws that shield that from the U.S. authorities. No one will ever know about it. I'm not sure the IRS knew the level of which it was at prior to 2007. But so Bradley Birkenfeld kind of opens up the door, or takes back the curtain and unveils kind of what's happening there. Funny enough, though, he didn't fully cooperate with the Department of Justice, and so he himself gets prosecuted and put in jail, I think, for like a year for not really playing ball with them. But in 2007, 2008, there's a pretty massive investigation into Swiss banking. And then that starts with the Offshore Voluntary Disclosure Program, which basically said that if you were a U.S. citizen or U.S. person and you had, these assets in Switzerland, but you hadn't reported them or the income, they had these amnesty programs that you could use that were strangely enough modeled off of a 2003 amnesty program for credit cards in the Caribbean. They had some success with that in 2003. So they said, let's try it again for 2009. And you had your first, what's called Offshore Voluntary Disclosure Program back then. That ran for a limited time. Then you had a 2011 one, limited time. 2012, that ran for a couple of years. 2014, that was kind of, I think, the last big OVDP, if you will. And Austin and I separately had done a lot of work in that area. I at that time was commuting back and forth between Austin, Texas and Zurich, Switzerland. The company I was working for had a sister firm in Zurich, and I spent a lot of time representing clients that had these issues, and kind of going, learning about Swiss banking laws and the inner workings of that. Fast forward then to 2016, and Austin and I are both named to the Texas State Bar Tax Leadership Academy, which was run fantastically. David and Christy did a great job with that. I don't know if they still do it or not, or I think it's like an every 3-year thing, but I still to this day, it's one of the coolest things that I was able to participate in. But we met there, and we were, strangely enough, I think the two people that were super interested in the international tax. They had a segment, I think, on that, and we started to talk about it. I was like, "Oh, you do that?" And he's like, "Yeah." So we got to learn more about our practice areas. And when I joined the Wolf Group in 2017, at that point in time, I had made a command decision that I didn't really want to be preparing non-willful statements or doing the legal side. CPAs, in my opinion, CPAs should just be CPAs, and attorneys should be attorneys. Now, Austin is your rare CPA attorney that does it both, and we'll talk about that here in a minute. But I wanted there. I felt like I still to this day feel like there needs to be separation there. I think if you're doing an offshore voluntary disclosure or something that is that sensitive in nature, that the accountants should do what the accountants do, and the attorneys should do what the attorneys do, and the two shouldn't really overlap. I think there's a conflict of interest there. And so ever since, Austin and I, maybe even before that, but Austin and I have been working together for a long time on a lot of these client files. We've done, I got to say, somewhere close to 1,000 of these submissions, just getting them. It's a lot. I know we've done a lot. Again, I don't know the exact number of it. But Austin is a great sounding board. We kind of keep each other accountable and in check on kind of, the positions that are being taken and the paths that are being chosen for clients. I always love to hear his thoughts and comments on, complex client situations. That's what normally gets thrown at us, are these complex client situations that have curveballs. And it's always great to bring in, a practitioner like Austin to kind of hear what he's thinking, what he knows is going down at the IRS, the current comings and goings down there. So I'll pause for a minute. Austin, you want to tell us about your background a little bit and your work with Gray Reed, the law firm that you're at?
Yeah, absolutely. And I'll just give a couple more, a little bit of flavor of what Mishkin was talking about on this FBAR stuff. It was estimated in 2000 or 2002 that compliance with FBARs was, I think, at like 2 to 5%. Yeah. So things have changed drastically. And now here we're sitting in 2024. And, if you have, you can have the minimum amount in your bank account to have an FBAR filing, and you could potentially be facing large penalties. And it's a big thing on the IRS's radar. So wild how things change over time whenever something gets high on the IRS's compliance radar.
And if you look at those FBAR filings, Austin, it's like hockey stick growth, right? It's like the compliance rates have just ballooned.
Absolutely. Yeah. So thanks for the brief introduction. I'll give a little more about myself. I'm an attorney and a CPA at Gray Reed. We're a full service law firm in Houston, Waco, and Dallas. And we don't practice on the compliance side. I also agree with Mishkin that if you have a project that requires both attorneys and CPAs, we also agree that we need the CPAs to handle the compliance side and getting returns done. And what we handle is the legal analysis. And it's essential. What I tell people when we do these programs, when you're doing an amnesty, you are in fixing issues, you're giving the IRS everything they would need to go after you with the full amount of penalties. And so it's essential that, your analysis of kind of how you acted, why do you have a mistake? Why was there unreported accounts or income that's done correctly? I like to say that you want to make sure you're opening up the right door at the IRS, because there's significant consequences going from there. But, real brief. So in addition, we do all broad types of international tax, inbound, outbound, amnesty programs, penalty abatements on the business side as well. And then we do other tax and MA too. But would love to get into the meat of this. I know we got some great questions that we're going to discuss, and really, exciting things happening right now, pretty much always, but in the tax world.
And Austin, if you look at your profile online, and I'm always love to tell people this, because sometimes I think they just think that you're writing the non-willful statements and kind of giving advice on international tax issues, and that's it. But you have some substantial. I mean, I'm just going through it. I was kind of preparing for this interview, and I'm looking at it. I'm like, yeah, I know he does this stuff, but the M&A, you do a lot of M&A, you do a lot of business structuring, you do a lot of domestic work too. You want to just briefly kind of talk on that, because this isn't just international tax, this is essential tax. So
yeah, no, absolutely. So we do work on M&A transactions ranging from a few $100,000 to over $1 billion. And, we handle complex 1031 exchanges, qualified opportunity fund planning, pretty much anything you can think of for business owners and high net worth individuals. We handle that in addition to the international side. Help with tons of penalty abatements. We are able to help with really technical, if you have issues that require private requests from the IRS, they're called private letter rulings. In certain cases, when you need relief where the code doesn't provide it, you missed an election, et cetera, we're able to get that. And, we've seen $1 million+ refunds because we're able to get, special dispensation from the IRS. So we're a full service shop. I do more than just the international kind of non-willful and reasonable cause as well. So appreciate you bringing that up.
No, absolutely. Absolutely. Okay. So let's talk a little bit about the main topic for today's discussion, which is, I alluded to it earlier, it's the Moore case. To give everyone some background here, and maybe I should have combined the two timelines together, but the controlled foreign corporation rules are kind of what the Moore case is getting at. And those came into being a very long time ago. They're one of the oldest set of rules that we have in the US tax code. So to frame of reference, I think, for everybody, you got to go all the way back to World War II. And for those of you that paid attention in history class in high school, the Marshall Plan, basically, hey, U.S. businesses, it's World War II has ended. We want you to try to be more global, have a global reach. So you saw a lot of U.S. businesses kind of expand out into the rest of the world, trying to prop up Europe and Asian economies. And so you really get a lot of companies that were, now not just domestically located, but located in both the U.S. and a foreign country. Well, the problem with that is that there was no real way to disclose worldwide income or any of that stuff. So in the 1960s, they came out with, a certain set of rules about disclosing controlled foreign corporations. And the first controlled foreign corporation form was not the 5471, believe it or not. It was a form called the 2952. That form is later replaced by the big form, which is the form 5471. But the 2952 is what a lot of people filed for many years to report their interest in a foreign corporation. And for the most part, those rules have pretty much stayed the same until 2017. So what you could do is, prior to 2017, was you could open up a foreign company. And as long as you didn't violate certain traps called subpart F and 956, and a lot of people were able to design their offshore structures to make sure they didn't violate those rules, you didn't have an income that you had to report from the foreign corporation. So if you didn't give yourself a dividend, you didn't violate one of those rules, you got what's called deferral, which deferral is a dirty word in the U.S. tax code. You don't really get deferral unless you have a qualified U.S. product, but you were able to defer taxation. So you saw all these companies just basically stash earnings and profits offshore in foreign companies. Ireland's a great example of that. You had a lot of big companies in Ireland that were just stashing it out there. We fast forward to 2017, and as part of the 2017 Tax Cuts and Jobs Act, the goal there was to end the deferral regime and bring in a new regime where there would be kind of an annual tax. And this is what Congress thinks of foreign corporations at that point in time. The tax is called GILTI, spelled GILTI. But to get from the old regime to the new regime, you have to build a bridge. There has to be something that gets you from the old to the new. And that was called the transition tax. And so what the transition tax did is it imposed a one-time mandatory tax of about 15% on liquid cash, and I think 8% on non-liquid. But it was imposed one time in 2017, and basically all those earnings and profits that you had stashed overseas, you got taxed on them immediately as if you had distributed those out or given yourself a dividend. Well, that's fine and dandy for the big companies that have probably been preparing for that, but for the small to medium taxpayers, it kind of came as a shock, and they were handed these massive, here's your transition tax bill. Oh, don't worry, you can pay it over 8 installments over an 8-year period. It's okay. And the Moores, there's a really small amount of transition tax, relatively speaking. They took issue with that, and so they filed, a case with the IRS. I believe it was a claim of refund. And this thing got all the way up to the Supreme Court. And when the Supreme Court was kind of going through it, really bigger picture issues came into play, which we're not going to really talk about here today. We're not going to talk about can Congress pass a wealth tax? Can Congress, does the IRS have the right to do pass-through taxation? Are those laws no longer valid? Should there be a realization event? Those are all, we'll leave it up to the congressional scholars to trip over all of those issues and go through all that. But practically speaking, for the normal everyday client, that's where we're at. We now have that the Supreme Court upheld the constitutionality of that action. And so there's two things in my mind. One is, now we know that that tax is constitutional, because at that time I was one of the people saying, hey, I don't think this is constitutional. But number two, what's to say, and we'll talk about this, that something similar to that couldn't happen here in 2025 when the Tax Cuts and Jobs Act expires. There will be something new that will have to go in to replace it. It could be somewhat similar to what we have, but there may be something new and that could follow along those same lines. So with my first, and then the other thing I wanted to provide here was to go back to the 5471. So I want to give full context before we get these questions. There are statute of limitations to the transition tax and to the filing of Form 5471 if you have filed, okay? Right. That's the big key there, and that's Internal Revenue Code 6501. We're going to link that, all the stuff in the show notes. We'll link the Moore decision, the assessment statute of limitations. But if you haven't filed, there's this weird little provision, 6501C8, that basically says that the statute of limitations remains open because you haven't filed that international informational form. So the Form 5471, or if you have a foreign trust, 3520, 3528 could possibly be it, the 8938, which is similar to the FBAR. And then there's a court case that also says that not only does it keep the statute of limitations open for the form, but the entire tax return. So think about this: the IRS could come back and say, "Hey, taxpayer, we're going to examine your 2005 tax return. We want you to tell us everything about it. We know it's 2024, but guess what? You never filed that form. We've got the right to go through all of it right now."
And this is just jump in. I mean, this is a huge difference compared to the normal statute of limitations. If you only have domestic items in general, once you file, if there's no fraud or substantial understatement, they've got a 3-year clock from the filing to assess a penalty or assess additional tax. So again, international, going back to the history Mish was giving, everything is concerned about tax non-compliance, about people hiding money in the Caribbean and tax haven countries and Swiss bank accounts. And so all of the reporting regimes are very punitive in their penalties. And this is another area where they're punitive in that the statute of limitations doesn't run if you just don't file it. So it complicates the analysis because there's less when things are unfiled. And we'll get to our thoughts on, there's what could happen and what's the probabilistic chance of it. You got to weigh that a little bit, but certainly makes things more complicated.
That's right. And also the risk tolerance versus risk aversion of the client. I think that always comes into play. Are you going to be able to sleep at night? Are you okay with certain things the way they are? So okay, that's the context. Thank you, Austin, for kind of chiming in there and giving some more to that context. So my first question, Austin, what is your big takeaway from the Moore case? Big picture, if you were in an elevator with someone and you had to 30 seconds summarize. Now, picture you're in an elevator with someone that's got this transition tax issue or got a controlled foreign corporation. What's your big kind of takeaway to that person?
All right, I want a free 30 seconds to give a couple of sides, and then I'll give you my 30-second elevator pitch.
You got it. Go for it.
Okay, one, this Supreme Court case was over. Michigan said little amount of tax, $15,000. So just FYI, good luck finding an attorney who's going to take something to the Supreme Court for you for $15,000. Clearly, somebody had an interest in this, right, and was paying that bill. So it's not any issue of that size can go to the Supreme Court. There's got to be some powers that be that want this to happen. Other real interesting thing, in my opinion, we think of the Supreme Court as, very divided and people, oftentimes think it's very political, but on tax issues, a lot of times politics can get thrown aside and they have to think about the functioning of the government. And this is a perfect example. This will get to my elevator pitch. The court voted 7-2. So voted across, they're not party lines, but, who they were appointed by lines, if you will. And there was a strong emphasis that if more was decided for the taxpayer, that the Internal Revenue Code as we know it would be eviscerated. I don't know, all of us tax preparers and people in the tax industry, tax lawyers, we thought that what happened in Moore would be the answer. But if it wasn't the answer, who knows what would happen. The majority opinion discusses that basically the government would stop functioning because trillions of dollars wouldn't be able to be collected. It's pretty wild. So the elevator pitch is, it was expected that the court would narrowly uphold Moore because the implications on the remainder of the tax code, partnership tax law wouldn't work anymore. Most pass-through taxation wouldn't work anymore. It just wouldn't make any sense. But the court was also very careful to, keep the door open for future challenges against unrealized income, wealth taxes, things like that. If you are somebody who is sitting on the sidelines and you have never paid a transition tax because you were hoping this would get thrown out, I think you need to look at it again, and you need to figure out, what your exposure is. As we understand this happens sometimes when there's court case rulings that people that have compliance issues may wait. Well, this is it. The Supreme Court of law of the land now, Supreme Court said this is allowed. And so if there's material exposure and the IRS has more funding, is going after more international stuff, it would be a really good time to take another look at the amnesty. If you had paid it and you were hoping, you filed a protective claim for refund, et cetera, it's not going to happen. It's very clear. While it's a narrow ruling, it's a clear ruling that the transition tax, Congress had the authority to enact it.
Okay, so let's talk about this for a second, because you bring up some good points there. So if you've been sitting on the sidelines, you haven't filed your transition tax, maybe you haven't filed your 5471s, but you filed all the rest of your tax returns. So we're now here in 2024, everyone's filed through 2023. And now we're getting into 2017 through 2023 amended tax returns. We're kind of getting right back to offshore voluntary disclosure land, where you're doing eight years.
Yeah,
that's a lot. I mean, that's a big undertaking. What do you tell to someone that has that problem there? And does the statute of limitations that we talked about play into that? And then you may want to give some background on this kind of separate case that's been floating around, which is the Farhi case. And I think the Mookie case, hopefully I'm pronouncing that correctly, Mukhy, but they also, I think, kind of play a little bit into that decision-making process.
Yeah, boy, a lot to unpack there. So, okay, I'll tell you the first thing we always do, at least, my strategy for approaching non-compliance is you gotta it's like you go to the doctor, like, let's see what your vitals are, right? Let's see what the symptoms are, what the issues are. Because it's hard to talk in a vacuum of, oh, you've got a foreign account reporting issue. One size doesn't fit all. There's many ways to handle them, these issues, amnesty programs, or getting it right going forward, understanding that risk. So I always say the first thing is work with your tax professional. If you don't have one, get one, and quantify how much taxes due, what forms haven't been filed, and what are the potential risks with those forms, right? And then from there, we can make an informed decision. So if someone came to me and, for example, yes, they hadn't filed transition tax, but you do the math and there's, a nominal amount due, I would feel very differently than if someone comes to me and they've got $1 million of tax due under transition tax. Those are, people ask us all the time, what's the, where is the audit cutoff and where is criminal cutoff? And those don't exist per se, but big surprise, if you owe a lot of money to the IRS versus a little, there's different incentives, different penalties, and different risk, including, once you start getting into millions, you start to get into criminal risk, right? And where you're potentially being, especially if if you were just waiting on the sidelines, hoping the law didn't get passed, and or law didn't get upheld, and the law's been upheld, and that you owe a lot of tax, I think there's potential risk there. And then from there, I can get a little bit into Farhi. So another one of those people have been waiting on the sidelines is the Farhi case. So the Farhi case, Another one that's not a lot of penalties. I think it was like 50,000 or something of 5471 penalties. And I don't want to get too technical in all the ways that the stuff, how you can appeal things and, whether you go through tax court or district court, but effectively they made it to the United States tax court through a CDP hearing in response to a notice to levy. And the taxpayers assessed or took the position that the IRS did not have the statutory authority, aka the ability to automatically assess without formal proceedings, a lawsuit, etc., these penalties. And based on a very technical reading of the code, the tax court agreed. Well, then that got appealed by the IRS, and taxpayers that had 5471 penalties might have said, well, let's see what happens, right? Well, that got appealed to, I think, the 11th Circuit, which held that they overturned the tax court. So we're in a weird situation. You might say, okay, well, does that mean that the tax court's right, that the taxpayer's right? What's the answer right now? I'll tell you, I work on a lot of 5471 penalties, and the last time I talked to an appeals agent on this, the inside baseball, even before this pro IRS case, was that appeals was only going to rule in favor of a taxpayer if the taxpayer had the exact same facts that they were going to appeals through a CDP hearing. And so what that means is you can only go to through a CDP hearing if you have not paid yet, right? If they're doing a notice of intent to levy, right, and you are appealing that specifically. But if you're just looking for like a normal abatement, right, or normal refunds, that doesn't go through the United States tax court. That doesn't go through CDP, which gives you an avenue to the United States tax court. So you have to. They've taken this very limited scope that, and even then, I think they would look and see, which circuit you're in, and if you're not in the 11th Circuit, so you're in any other part of the country, they may say, we don't care. So it really depends. I think that the way the Farhi case is, especially with this latest appeals ruling, I don't think there's a lot of relief to be found on 5471 penalties right now on this very technical ground that they don't have the ability to automatically assess it. So the long and the short of it is these cases coming out are not taxpayer friendly. They are upholding the IRS's ability to collect the transition tax with more, and the circuit court is upholding the IRS's ability to uphold the 5471 penalties. And unless you are very specifically coming to appeals through a CDP, don't expect for them to give you any extra benefit just because there was a tax court ruling that was in the taxpayer's favor.
Right, and maybe you may have mentioned this, but just for the audience, a CDP is a collection due process hearing. Right. And so that's a super interesting answer, and thank you for that. I really like what you're saying because there's a strategy there, right? I think a lot of people kind of just willy-nilly, when they get these issues, they don't really think about the strategy of how they're going to approach it. So people just kind of try to jump to the very end and, just pay it and stop the interest from accruing, and we'll do a claim of refund. But they don't really, there's no strategy that goes into that. And that could certainly, be an issue for the taxpayer if you don't pick the proper strategy. Tell me a little bit more about the other types. So we have a lot of IRS cases. This has been a hot year. Last year was a hot year too for IRS tax court cases. And the results that are coming out are kind of wacky. So there was, I'll give you an example. There's this arrestee case where the court basically allowed the taxpayer to do a bunch of stuff that I was like, I've never heard you could do that. So the guy, I think in the case, filed a married filing joint return, and the court said, yep, we're okay with the fact that you amended the return to split it to married filing separate. Many years later, we're okay with you doing an old treaty tiebreaker provision, many years after you filed the return on an amended filing. We don't think the exit tax rules apply. So normally when you give up your green card under a treaty tiebreaker provision, if you've held a green card for a certain amount of time, the exit tax rules will apply. And they said, exit tax, they never did, notice in the hearing. Administrative Procedures Act, that one doesn't apply. So the APA has been used over and over and over again.
Very successfully. Very successfully.
Yeah. So let's just talk about streamlined filing for a second. And you can also tell me about any of these other things related to APA that you want to.
Sure.
But streamlined filing came out of, and this is I think where Austin and I really, our practice kind of jettisoned upward a lot, because offshore voluntary disclosure, there's only a certain amount of people that really fit into that, but a lot of people fit into streamlined filing. So streamlined filing is a subset of offshore voluntary disclosure that came out in 2014. Offshore voluntary disclosure was really meant for, and is still really meant for, true life, willful people. I loosely refer to them as criminals. Austin, you may have a different take on that, but I think it's serious, right? It's a serious thing. If you're going to do, offshore voluntary disclosure, you're going to say you're willful. I think that's a really serious thing, and you got to be real careful with that. If you're non-willful, though, which I think a lot of people are, just because they don't know any better, and they, there's this expectation, you should know, you should. I mean, unless you go down the path of the careers that Austin and I have and spend years doing this stuff, I don't know if the average American would know or understand all of these filing requirements. But here we have these streamlined procedures, which is the current modern day flavor for how you get back into compliance when you have issues with not filing certain international forms or reporting foreign income. And they're not, the guidance there is not formalized. It's not under a regulation. It has carries no real weight. It's kind of like a suggestion, like, oh, you want to come back in compliance, you should do this. And they have a form, so you do streamlined filing. There's a form that you fill out for streamlined filing that they put out. What happens if someone comes in and just decides they want to challenge streamlined filing under the Administrative Procedures Act? What if I have a client that's got $1 million of transition tax, but saying, hey, you know what? That's a suggestion that I should start with 2017 under the streamlined rules. I'm just going to do 3 years, and I'm not going to worry about my transition tax inclusion. I don't really care what the Moore case says. It's beyond the statute at this point in time. I filed my 5471. Let me challenge this under the APA. What do you think? And then also getting into this 8 and 8. Do we think there'd be changes to the streamline guidance? I mean, that's been sitting there pretty much as is for over a decade now. I'm not sure it was intended to be around for that long. Do we think anything could change there? So I guess it's a 2-part question for you.
That's like a 3-part question.
Lots
of unpack. Okay, real super short cliff notes, because another really technical area that like no one really wants to listen to on this. The APA, Administrative Procedures Act, is a law that requires administrative agencies, if they're going to issue regulations, for there to be like notice and comment periods. So, effectively for non-elected officials to not be able to, create law, without any sort of checks and balances from the public, et cetera. Well, Treasury regulations, which we're all very familiar with as tax practitioners, fall under this. And so there's been a lot of challenges to Treasury regulations that taxpayers didn't like, and saying, well, you didn't issue it the right way. That's the super short version of that. Then what Mishkin's talking about, these amnesty programs are kind of they're created in an even less official way than the Treasury regs, right? Treasury regulations, the Internal Revenue Code is like, that's created by Congress, and then Treasury is allowed to make regulations under it. The streamlined procedures and other amnesty programs are in this real weird gray area where the IRS has decided to, permit people to have, another way forward, but it's not specifically, and explicitly, it's rooted in some basic principles and certain penalty sections where they can kind of grab onto it. But like Congress didn't write a law saying, yep, IRS, make the streamlined procedures. We're glad they made it 10 years ago, because it's been a very successful program. It allows taxpayers that need to get into it a way in. So Mishkin's question, really interesting. Was thinking about it before, beforehand, is what if someone challenges the streamline? So my thought is this: if you've gone through the streamline, if there is later a challenge to the streamline, I don't think there would be any negative consequences to you. I wouldn't count on you ever necessarily getting your 5% penalty back or tax back. Even if there is a challenge, it could happen. But I wouldn't, if something happens to it because people challenge it, I don't think that people that have been successfully processed through it are going to have any issues, because they've already paid their penalty. the IRS is not going to, they wouldn't risk the brouhaha that would come out of that. And, everybody calling their congressman that they changed the deal and pulled the rug out from people. I just don't think that there's a problem. So if you've gone through Streamline, I don't have a lot of concern that, a later challenge to it would change the deal that you got. But could somebody pay a penalty, or maybe not even have paid the penalty and then later challenge the penalty? Yeah, it could definitely happen. And if it does, I'm not really sure what the IRS does other than shut down the program or suspend the program. Again, I don't think that they would do anything to people who had gone through beforehand. So I think that's interesting. I sure wouldn't want to file a Streamline that just doesn't pay the transition tax. Like if their guidance they've given us, which they've been true to their word for 10 years of doing this, is if you do these things, here is the outcome. And through doing 1,000 of these, that's been exactly true. So I'd rather, if I didn't want to pay the transition tax, I'd probably choose another avenue versus the defined path they've gone and the deal they've offered, but then they've said it's non-negotiable and trying to negotiate that channel. The other question is, will the rules change at some point? Because as Mish pointed out, this is a lot of years back you got to file, because the rules say it's typically 3 years, but if you've got transition tax, you got to go back to 2017. I think they might. So, when Mish and I have been doing Streamline since the day it came out, and we were doing this before the prior versions of the program. And when this program first came out, I used to give speeches with an IRS agent there who wrote the program. And one of the questions that was always asked was, how long will the program be around? And the answer was always, as long as there's a business purpose. I did not think in 2014 that I'd be given a podcast in 2024 about streamlined procedures, but here we are. And, it started in 2014, but the transition tax came out in 2017. And then at some point the IRS had to figure out and say, well, that's not fair. If we make people only do 3 years, they're going to get out of the transition tax. So they responded in a rational way. I've had great interactions with the Streamline unit, really good people, really helpful. They've done a really good job of creating a clear, concise, and efficient path to resolution. I think at some point they're going to have to look at it and say, maybe what you do, instead of having to file 8 years, in other contexts, when we do sometimes these private letter rulings, there's a concept called, specifically with PFIC elections, QEF elections, if you have a prejudice to the government because of closed year statutes, you can pay basically an additional tax to get right for the closed years. So I wonder if that's a solution. At some point they say, look, we're only going to make you file 3 years, but in addition to the 5% penalty, you're going to have to show how much transition tax you would have owed, calculate it and pay it, but we're not going to make you go through the administrative burden of all of those extra years of tax returns. I think there's solutions that would still be fair. Because one point is, if you don't pay the transition tax, you're theoretically going to pay that tax at some point, because if you ever repatriate those earnings. So if you don't pay it, it's not going to turn into previously taxed income that you can repatriate. So I think there will be changes at some point. I hope the Streamline still stays around. I still see the business purpose. The volume we see in our shop is similar to most prior years. Year after year, there are new people coming to the U.S. who had, prior foreign issues. There are people who move abroad for the first time. There's people who, listen to the Wolf Group's fantastic, stuff and realize they have issues. People that change CPAs because they change jobs and realize there's issues. So I think it'll stay around for, hopefully a long time. And I imagine there's going to have to be, a fix at some point of not making people file back to 2017 for transition tax.
Yeah, look, I'm a big fan of the Streamline program. I think that it's a fantastic it's 2 programs in one. It's Streamline Foreign and Domestic, but yeah. I think they're fantastic options. I don't know what we would do without it. I'm a little concerned about the black eye the IRS got with the Delinquent International DIRSP program, supposedly a program, but it's not really a program. I'm also concerned that at a certain point in time, my tax software won't be able to do 2017, and then I'll have to handwrite the transition tax return, which
You can download the PDFs, Bish. It's so easy to do.
It's so easy. Yeah. But yeah, no, I like the program. I think, like you said, you're gonna have to pay the tax anyway at some point. The streamlined program also is that rare beast that no late filing or late payment penalties. So you get out of those, and there is interest. Interest is interest; it's always there. But yeah, those are all great points, and I really like your suggestion about calculate the tax. Don't have to file all those older years. Let that be, and just pay that as a kind of add-on to your 5%. I think that would be a great solution to the issue, and I think that would get the government what they're looking for. And I think that would get the taxpayers still kind of in the normal idea of what they're submitting. So, that should be something. You should probably send some comments to someone on that somewhere in the IRS.
We'll send the IRS this podcast, and
there we go. We'll let them look at it. Okay, so let's. I have one last question, and then we kind of open it up a little bit if you want us to know. Up to you, or we can close off. But the Tax Cuts and Jobs Act of 2017, and I still remember the day it came out, and like reading through it, and it kind of blew my mind, all the different changes that were in there. But the TCJA sunsets in December 31st, 2025, or a lot of the provisions. Some of them are forever provisions, like alimony, for example, is forever. The changes they made there, but it sunsets, and if it sunsets, then it's like Back to the Future, right? We go back to what was pre-TCJA, which I don't think they will let that happen, because I think studies are showing that's going to just cause a tremendous amount of problems. I think I've heard the term tax Armageddon, tax apocalypse, kind of like what would happen in the Moore case if they found it to be unconstitutional, right. Similar outcome. So it sounds like that's something new will come into play. We have no idea what that is. What predictions do you have for the TCJA sunset, for dealing with that? What do you think will come out of it? Do you think there'll be anything that that was in TCJA that may carry in to 2026? And then I guess I'm going to be notorious for these 3-part questions. What do you think about, for the first time ever, you could have an accountant? And this was interesting to me when TCJA came out. A lot of people that were doing CFC work and specialists in controlled foreign corporations, they peeled off. They didn't want to learn the new stuff. A lot of them were older in their careers, and they just kind of retired, and they didn't want to learn GILTI and the transition tax. And they were like, look, I've learned one set of law. I don't want to learn 2. Now we have potentially clients that could have issues. If you're starting with 2016 through 2026, you could have something that has 3 different, overlays of massive changes to the U.S. tax code. I think that's a lot to kind of keep in your head. And so what do you think about just the mass, being able to know all the different, especially with new accountants coming into the field, that they may have not ever done a return with TCJA stuff on it. They may only know what happens in 2026 moving forward.
All right, I'll answer the last one first. Complexity is not going away. The tax code will continue to get more and more complex. And that's why really important to, I tell everybody, like, please use tax professionals. Not saying that tax professionals get everything right, but one thing you should know is that when you work with a licensed tax professional and disclose your information to them, if there's an issue that comes up, in general, the IRS excuses you from it. So think of it as a little bit of an insurance policy if you have any level of complexity in your tax return, and everybody's getting more and more complexity in general. And we're going to have to rely on, as tax professionals, increasingly better AI, tax software tools, et cetera. No matter what, it's going to get more complex. To circle back, what type of complex? It's clearly going to heavily depend on which, where government goes, right? Like Trump or Biden, or Republicans going to win the House, or Democrats going to win the House, who's going to win the Senate. In 2025, I would anticipate that you're going to have tax legislation, regardless of who wins, the branches of government. If the Republicans, who are favored to win the Senate, kind of toss up in the House with their slight favor, 50-50 in the presidency, the Republicans sweep, then I would anticipate most provisions of TCJA to get extended. I would hope that a lot of things, no matter who gets elected, man, it'd be great if they could deal with downward attribution, if they could fix, the many glitches that exist in the code because it was kind of passed so hastily. But, if you see the Republicans take all three branches, expect to have, most of the provisions, continued. That's what I would think. But probably with changes, because they're going to ultimately have to have this scored by the CBO. That's the Congressional Budget Office. And there's going to be concerned about, how much are they increasing the deficit, and talking points for the other side. If you have divided government or a Democratic sweep, which seems less likely, divided government, most people think that's the most likely outcome right now. Whether that's Republican Senate and, Republican or Democrat House, or, Republican Democrat presidency. But even then, there's just no way that they have to address this. There's just too many things happening. There's the estate tax exemption, which is about to, get cut back in less than half, which is going to cause significant issues. The income tax provisions. I would say, if you maybe a really good, we think a lot in the tax world, history repeats itself, just like with a lot of things. And, a good example of this would be when the Bush tax cuts expired. Those were created in 2001. They expired at the time that, Democratic President Obama came into power, and there was a big change in the tax code. But what they did in that case is they kept a lot of the provisions for lower income earners. Pick a lot of times 400,000 is a dollar amount that's thrown around. So, maybe you'd see something that a lot of the tax, differentials, tax rates, 199A, different brackets, those may be extended for lower income earners. Certain tax credits may continue to be, et cetera. But, if you have, Democratic control, maybe you see tax increases or, a lot of these things expire for higher income earners. So you're going to see a change in tax legislation. There's no way it doesn't happen, because that's, this is what happens when we have expiring tax bills, is that you have to deal with it at some point. And, it's hard to believe, but here it is, time to do it again. And then we should learn something new, right?
Absolutely. And for those of you that don't know, for the audience members out there, they're already talking about this, the Democrats and the Republicans. They have their tax writing committees doing what are called road shows, where they're going around the United States and they're taking Q&A and they're asking people to write in on certain topics. I had a client the other day tell me, Mish, I'm going to write them about the miscellaneous 2% deductions on Schedule A, about the salt limitation. That's because I think those are some ones that affect people, personally. I think a lot of people would love to see kind of come back into play. I don't know if they'll allow that in there, because, like you said, the CBO scoring has got to. They got to hit that number. For the first time ever, though, I did hear the Republicans mention that some Republicans, not all of them, were okay with seeing the corporate tax rate go up, not only because that would help with paying for certain things. So, for example, if it jumped from 21 to 24, but because the United States in general has to play ball with the OECD, and there's this thing in the OECD called Pillar 2. We're not a member of it, but we've got to go along with the rest of the world to do business. And so Pillar 2 basically is trying to say that throughout the world, there needs to be a minimum corporate rate of 15% of tax. And the United States currently does not meet that 15% threshold. It's, I think, at 13.125. So to get that number up to 15, you got to raise your corporate tax rate to make the math work out properly. I suppose you could lower certain deductions and maybe get there too. But, there's all sorts of things being tossed around here. So it's super interesting. I think they're giving the tax writing committees a lot more leeway and time to deal with this than they did last time. They only really gave them, I think it was like a 6-week window to write up all their different proposals. And that's why when Austin was saying, he wishes a lot of the stuff, the technical corrections were being implemented, that's stuff we're still waiting for from TCJA, is the technical corrections bill on all the stuff that just was not done correctly. They actually wrote some of the law by hand in the margins as it was being passed, so it would be great if for this time around, whatever it is that comes out is actually thought through a little bit more, similar to 1985 and 1986. I think that's a great model. You had, bipartisan, they talked about it, they went over it for 13 months, they put it into play. that 1986 tax code, is still a good example of, whether you liked it or not, it's still a good example, though, of something that's well thought through. And so, yeah, it'll be super interesting to see what the TCJA sunset kind of ushers in and what is dealt with there. We're also juxtaposing that on some upcoming podcasts. We're juxtaposing that with our good friends across the pond, the UK. They have their general elections on July 4th, believe it or not. And we'll be talking to some folks over in the UK that will give us their insight into how things are changing in the UK. There's supposedly some big tax changes on the UK side. So they're kind of going through their version of the TCJA sunset right here and now. So we get to kind of watch their drama from our end right now, and then they'll watch our drama from their end in 2025. So stay tuned for that podcast. That'll be super interesting. We'll actually be doing a series of podcasts on that, as I was told that there are several different time periods that you have to keep an eye on for the UK. All right. Well, I think that's it. Unless, Austin, is there anything else you want to throw out there to the audience or put out there that you think people should know about that's relevant?
I think that's good. We covered a lot, and yeah, I mean, there's a lot of things, going to be coming down the pike here. And, of course, anything you hear on this that you have any questions on, we're always available by email or phone call. Feel free to reach out, and happy to give you any thoughts. And, we're always happy to help on these things.
And we'll link Austin's profile, his contact information, his bio, all of that will be in the show notes. He's a fantastic attorney. You don't need to be, Austin, you may want to clarify this, you don't need to be in Texas to use Austin for federal tax matters. Austin can literally deal with anyone in any state, any foreign country. Is that right, Austin?
Yeah, we work. That's the great thing about federal income tax. It's the same everywhere. So we work with people across the country and across the world on federal income tax issues.
Yeah. Okay. So yeah, if you have issues that are related to international or some of the other domestic practice areas that Austin mentioned, he's a fantastic option. Give him a ring and see what he can do for you. Austin, it was truly a pleasure to have you on the show. I'm sure we'll have you back and talking more about this. I'd love to get you on here at least a couple more times, maybe before the end of the calendar year. And then definitely when we really get into the nuts and bolts of the updated TCJA, I really want to pay some close attention to that. So, because one area that I know that you practice in that I always have questions on, but I've really never gotten into is the qualified opportunity zone and qualified investment fund. And I'm hoping something similar comes up like that, the 1031 stuff, which you're so good at. But
absolutely.
With that, I will leave it for the day. Thank you for joining us, and we'll see you on the next episode.
All right. Thanks, everybody.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.